Silver is trapped. Right now, at this moment, silver is being crushed into a narrowing triangle on the 4-hour chart, and that pattern is about to run out of space. In the next 2 or 3 trading days, maybe sooner, silver will not be able to hide inside this range anymore. It will have to choose, and that choice is not small. If this breaks higher, the chart points toward 105. If it breaks lower, the move opens the door to the low 70s. That is not noise. That is a violent split in outcomes. And while that pressure is building on the chart, the biggest banks in the world are swallowing physical gold. Iran is threatening the digital spine of the Middle East, and the war is spreading into places the market still refuses to price correctly. You are not watching a normal metals market anymore. You are watching compression on the screen and panic under the surface. Let's start with silver because the chart is screaming. Pull up the 4-hour structure and look at it with clear eyes. Lower highs are pressing down from above. Higher lows are climbing from below. The space between those lines is disappearing candle by candle. Volatility is shrinking. The range is tightening. The market is storing energy. And when silver does this after a major move, it usually does not drift out quietly. It explodes. The reason this setup matters so much is the size of the projected move. A clean break higher carries a measured target around 105. A clean break lower points to the 70 zone. That is a roughly $30 battlefield opening up from one pattern. One break, one decision, one market-wide verdict. Now here is the question that matters. What decides the direction? Because triangles do not break in a vacuum. They break in response to pressure. Real pressure, physical pressure, macro pressure, war pressure, institutional pressure. And the pressure building underneath silver right now is coming from the gold market, the energy market, and the geopolitical map all at the same time. That is why this pattern is so dangerous. It is not just technical, it is loaded. While most people were staring at intraday candles, something much bigger was happening in the gold delivery system. One bank stepped forward and shoved an extraordinary amount of gold into the delivery pipeline in a single day. The size of that move was so large, so concentrated, that it stopped being routine market activity and started looking like a message. Nearly the entire issuance side of that day's delivery flow came from one major institution. Hundreds of millions of dollars in gold, in one session, at these prices. And when you looked at who was on the other side, it was not retail. It was not tourists. It was not momentum chasers. It was the largest financial names on earth taking delivery. Think about what that means. When multiple giant institutions all show up on the same side of physical gold at the same time, they are not buying because they feel emotional. They are buying because their models are flashing red. They are buying because something in the global risk structure is changing fast enough that paper promises are no longer enough. Gold does not need a server. Gold does not need a password. Gold does not need stable electricity. Gold does not care if a cloud region goes dark or a shipping lane closes, or a sanction regime shifts overnight. Gold just sits there and remains gold. In a world that is suddenly becoming more fragile by the hour, that matters. And the amount matters too. This is not a few scattered deliveries. Month-to-date gold delivery demand has already swollen into the billions of dollars. Billions. In days, not months. That is the kind of pace that tells you the biggest players in the system are not waiting around for clarity. They are moving before the public narrative catches up. They are not asking for permission from headlines. They are acting on probability. And probability in their models is clearly pointing toward more instability ahead. Now let's connect that to the war, because this is where the market stops being lazy and starts becoming dangerous. Iran is no longer limiting its threats to bases, refineries, or shipping. The threat set has widened. What is now being placed on the table is digital infrastructure, data centers, cloud systems, the invisible machinery that modern economies depend on every second of every day. Banking transactions, hospital systems, logistics platforms, government databases, private enterprise networks, financial records, cloud computing environments. The modern economy looks digital because it is digital. And digital economies still depend on physical targets. That is what makes this escalation so serious. Hitting oil infrastructure is economic warfare. Threatening the cloud backbone of the Gulf is something bigger. It is a threat against the nervous system. If major data infrastructure across key regional hubs becomes vulnerable, then the risk is no longer confined to crude flows. It spreads into finance, healthcare, payments, communications, business continuity, and civilian daily life. This is the kind of threat that rewrites insurance models, capital allocation decisions, and regional investment plans in a single stroke. Even if such attacks never happen, the threat alone changes behavior. That is the part shallow analysis misses. Markets do not wait for buildings to burn before repricing risk. They reprice when the probability distribution changes. The moment large multinational firms have to factor in the possibility that cloud infrastructure in the Gulf could become a direct target, future investment slows, costs rise, hedges expand, and capital starts looking for safety. That safety does not live in narratives, it lives in hard assets. And this war is not becoming narrower, it is becoming less selective. That matters even more. When mediator countries, neutral shipping, and non-core actors start getting dragged into the blast radius, the message to global capital is brutal. This map no longer has clean boundaries. Once a conflict starts leaking beyond clean military logic and into broad disruption, markets lose the ability to neatly price safe zones. Suddenly, it is not just about whether a refinery gets hit. It is about whether a corridor remains insurable, whether a port remains functional, whether a city remains investable, whether a data region remains dependable. That is why office evacuations matter. They are not symbolic. A major global bank does not move staff out of a financial hub because social media is nervous. It does it because internal risk assessments say the threshold has been crossed. Those internal models are not built by amateurs. They factor intelligence, infrastructure vulnerability, escalation pathways, and operational continuity risk. When those models say pull people out, that tells you fear has moved from television to boardroom. Now add oil to this. Crude did exactly what confused markets do during real geopolitical stress. It ripped higher on panic, collapsed on calming rhetoric, then rebounded when contradictions surfaced. That tells you the market has no stable anchor for this conflict. One moment it hears, "The war is nearly done," and oil falls out of bed. The next moment it hears a different message, or sees a new strike, or watches a new threat emerge, and the bounce begins again. This is not healthy price discovery. This is emotional whiplash. And the more unstable oil becomes, the more supportive that environment becomes for gold, and then, by extension, silver. Why? Because prolonged conflict plus energy disruption means inflation risk does not go away cleanly. It mutates. It re-enters through shipping costs, fuel costs, insurance costs, rebuilding costs, and fiscal response. Then come war spending pressures. Then come supply chain distortions. Then comes the strain on currencies pretending everything is under control. Gold sees that before most people do. Silver usually reacts after gold proves the move is real. That is why what is happening in gold delivery right now matters so much for the silver triangle. Gold is quietly building the case. Silver is waiting to amplify it. And gold is holding. That is the other key. Despite all the headline chaos, despite violent swings in oil, despite the usual attempts to shake confidence, gold keeps finding buyers on weakness. That kind of support is not decorative. It is built by real demand, physical demand, the kind of demand that does not care about intraday sentiment because it is positioning for structural disorder. Every dip that gets absorbed strengthens the floor. Every floor that survives strengthens the next leg. And when gold starts climbing from a floor built by aggressive institutional accumulation, silver shorts begin to sweat. Because silver is smaller. Silver is thinner. Silver is nastier when it moves. Gold can rise with dignity. Silver rarely does. When silver is compressed and the macro setup turns supportive, the move becomes disorderly. Shorts do not exit gracefully. They lunge for the door together. That is why the 89 to 90 zone matters so much. If silver clears that area with gold pushing higher in the background, the whole emotional structure of the short trade starts to crack. And once the market senses that, the measured move toward 105 stops looking wild and starts looking mechanical. But do not ignore the downside risk, because disciplined analysis has to respect both sides. If gold loses its footing, if the war de-escalates faster than expected, if risk appetite suddenly returns and the dollar rips hard enough to squeeze metals, then silver can absolutely fail downward from this pattern. The low 70s are not a fantasy target. They are the bearish resolution if this compression breaks the wrong way. That is why this moment matters so much. We are not in a market where nothing is at stake. We are in a market where the next break defines the next major chapter. Now let me tell you why I still think the upside has the better odds. First, the physical gold behavior is too aggressive to ignore. Giant institutions do not all rush into delivery because they feel mildly cautious. They do it because they expect conditions to worsen, not improve. Second, the war is broadening, not shrinking. Threats are no longer limited to classic military targets. Once digital infrastructure enters the conversation, the market has to think bigger about systemic fragility. Third, oil volatility is telling you confidence is shallow. A market that truly believes peace is near does not keep snapping back on every new contradiction. Fourth, gold is absorbing stress instead of collapsing under it. That is usually a sign that stronger hands are underneath the market. And fifth, silver itself is not breaking down cleanly. It is coiling. It is holding enough structure to remain dangerous to anyone leaning too hard on the bearish side. There is another piece people are missing: China. When energy disruptions start hitting the world's second-largest economy, the consequences travel fast. Fuel stress in China is not a local inconvenience. It is a global warning sign. It speaks to supply vulnerability, industrial strain, consumer anxiety, and broader inflationary knock-on effects. It also matters specifically for precious metals because China has been one of the most important centers of physical gold demand. When economic uncertainty collides with visible supply stress, gold demand does not usually fade. It deepens. So now step back and look at the whole picture at once. Silver is compressed into a terminal chart pattern. Gold is being accumulated through delivery channels at an extraordinary pace. War risk is moving beyond oil into technology and infrastructure. Major institutions are acting like continuity itself is becoming more valuable. Energy markets are unstable. China is feeling the strain. Global messaging is contradictory, and the public still thinks this is just another noisy week. It is not. This is one of those moments where multiple fault lines start vibrating at the same time. The chart sees it. The banks see it. The delivery data sees it. The war map sees it. The only people who do not see it are the ones still waiting for television to summarize it neatly after the move has already happened. And that is why the silver triangle matters so much right now. It is not just a pattern, it is a fuse. If the break comes higher, the move could be savage. Not because of hype, but because compressed silver plus rising gold plus escalating macro stress is exactly the kind of cocktail that creates air pockets above price. Once momentum punches through and shorts start covering, the market can jump levels instead of trading them. That is how silver turns a breakout into a chase. That is how 90 becomes 95, and 95 becomes 105 faster than most people think is possible. If the break comes lower, the punishment could still be severe. A failed support structure in a nervous market can invite fast liquidation. That is why the next couple of trading days matter so much. The apex is close. Time is almost gone. The market cannot keep pretending forever. It has to declare itself. So watch the clues. Watch whether gold keeps getting bought on dips. Watch whether new war headlines keep widening the conflict map. Watch whether silver holds support when pressure arrives. Watch whether the large banks keep favoring physical exposure. Watch whether crude remains unstable. Because each of those pieces feeds the same final answer. A huge move is coming. The chart says it. The delivery desk says it. The war says it. The energy market says it. And when the biggest banks in the world start grabbing gold while silver is being squeezed into a pattern this tight, you should understand something very clearly. They are not positioning for calm. They are positioning for impact. So now the question is simple. Does silver break toward 105, or does it get dragged toward 70 first? That answer is almost here. The room inside this triangle is nearly gone. The pressure is almost maxed out. And when this thing finally breaks, nobody will be able to say the warning signs were hidden. They were everywhere. Drop your view in the comments. Do you think silver breaks up or down from here? And if this explodes higher, do you think 105 is just the first stop? Subscribe if you want the next move broken down before the crowd sees it. Follow the data. Ignore the theater. The next few days could decide everything.